All right, everyone should be in the room. Well, hello everybody. It's Tom here from FX Evolution, and welcome to another week of Learn It Live webinars. I'm very happy to be here. Got some interesting information to go over tonight, and as always, I'm joined by Tyrone and Bella.
Hi everyone. Yeah, welcome to our next edition. Tonight should be really good for the people who are interested in trade plans.
Yeah, tonight we're going to be going over how to develop a trading plan in 5 steps. So it's really important that you have a trading plan. A lot of people don't, but also it's really important that we follow quite a few different rules when we're trading. So we need to treat our trading kind of like a business, and you'll hear us talking about that a lot in all of our webinars, but specifically tonight. So just to start off with, we'd like to go through the risk warning. The information provided here has been produced by third parties and does not reflect the opinion of Pepperstone, and the information has been provided without any alteration or verification. So what are we going to be covering tonight? We're going to be developing your trading system. We're going to be establishing a time frame for your trades. So this is going to be something we'll talk about a bit in terms of your psychology as a trader and what's going to suit you best. We're going to be using sound risk management strategies, staying in control of your emotions and how to track them, and understanding your mental impact of trading. And then we'll be looking at journal and tracking everything that you do in trading. And this is one that I find a lot of people don't do because it becomes all a little bit too hard, doesn't it, Tyrone?
It does, and it's actually one of the most important things that you can do as part of your trading. Whether you're successful in a trade or not, it's really, really good to know, why you were successful or indeed why you weren't, because you can learn a lot from both outcomes. So it is very, very important, and many people overlook it.
Learning from your mistakes is obviously one of the most important things in life, but the problem is that it's too easy in trading to forget why you made that mistake and therefore make the mistake again and again and again and not be accountable to it. So journaling and tracking everything is something that's very important to all of your trading systems. And then of course we've got the Q&A, which we'll answer at the end of the webinar. So feel free at any time just to ask a question in the chat, and one of the guys from Pepperstone, he'll get to that question and he'll take some of the best ones at the end and we'll answer those, which will hopefully help everybody out, because a lot of people have the same questions and we love answering questions at the end. We think that's one of the best parts of these webinars, being able to interact with you guys at the trading level. So let's talk about developing your trading system. Arguably one of the most important things. Obviously we need to have a good trading system. So your system can't just be lines and indicators. So what this means is that we can't just say, okay, we're looking for this specific pattern and we have these indicators on there. So let's say we were looking for a channel pattern and we had just stochastic and MACD on there. That's not just your trading system. It's about more than that. You need more than just those reasons, and you also need to think about, well, what happens when I get involved in the trade? What happens with my stop loss? Where is my stop loss going to be? Am I going to have a stop loss or not? Where's my take profit going to be? What are my risk rewards? These kind of things we need to think about. So your system really just can't be lines and indicators. And I think Tyrone will probably mention something else about that now.
Yeah, look, every trade preparation is a preparation like you're preparing a meal. It's not like you can just throw things together and it's going to work out. What makes professional traders, well, the one thing that professional traders all have in common is that they all have a system they can follow, that the repetitive steps are what they follow that makes them successful. The only way that you can build a trading profession is to be able to replicate the same things over and over again and follow those rules. You can't just use gut instinct or have a feel for the market, because look, let's be honest, even if you think you've got a feel for the market, for the most part, you're probably just getting lucky. Like even professional traders, they certainly get a feel for what the market is doing, but they don't deviate from their initial rules. And that's the important part. When you do follow a structure, when you do get a level of success, so, and by that I mean, several months of positive trading where you're winning more than you're losing and your winners are bigger than your losers, that hasn't been just chance or luck, that you've actually done that following a system. And if you haven't got a solid system in place where you can completely replicate the same thing over and over again, it's just not a sustainable model. And that's why that part's so important.
It's really important to select the right tools for your trading system as well. And this is one that I think a lot of people often overlook. They use really the wrong indicators in the wrong scenarios. And we find that that's very common. One of the ones that sticks out to me is really stochastic. It's something that a lot of people use and they put it on their charts and they're always considering, okay, it's overbought, I'm going to sell the market. Well, stochastic works really well when you're in a range-bound market, and then it can be one of the most effective indicators, and we've talked about this before. But it may not be as effective when you're in a market that's trending, because all of a sudden, overbought, yes, it's overbought, but it can continue another potentially 100 pips before that overbought signal ends up being correct and the market does come down. Tyron, how often do we see this?
Oh, all the time, and even on some of the bigger time frames, it could stay there for weeks. Like it could just when a trend is really in play, it can stay overbought and oversold for a very, very long period of time. And trying to stop it is literally trying to catch a falling knife. So, and the same goes for things like moving averages. Like moving averages, a lot of people trade a simple moving average crossover as a trading system, which is a great trading system in a trending market. But if you try to do that sort of system in a range-bound market where you should be using stochastics, you're going to be chopped to pieces. That we call that the ribboning effect, where moving averages just cross over like a ribbon because the market's just simply not going anywhere. So those indicators and tools, if you like, are just not suited to that market condition. So choosing the right tools for the market condition is vital when you're putting your plan in place.
Yeah, so really selecting the right tools for your trading system, very important. I think it comes down to a little bit of common sense, but also if you are using a specific thing or you're adding something to your system, what's very important is that you realize how is that actual indicator forming? Does it make sense to be used in like a trending market or not? So we also need to talk about when is your strategy effective / not effective. So some people have things like breakout strategies. Now they're going to be effective obviously when there's a breakout, but they're not going to be effective when there isn't a breakout. So you need to be aware of what you're looking for and when to use it. Again, that's kind of like selecting the right tools for your trading system, but it's really important to understand when things are effective. Now, sometimes that also comes down to natural events. I remember a tsunami in Japan, and that really hurt yen trading in terms of that it was up and down. It was very volatile, obviously, but in terms of using a breakout strategy maybe, or even just a trend-based strategy or anything like that, all of those technical rules can go out the door at that time. Another one was the Euro Swiss. So the Euro Swiss was arguably one of the fastest moves I think I've ever seen. It probably is the fastest move, 30, 40 cents in 5 to 15 minutes. It was insane. But that is when you're not going to have an effective strategy potentially with your technical trading. And you need to be aware of that and shut it down, kind of like you shut down maybe an algorithm during that time as well. So really understand your system and when it's effective and not effective in the markets.
I think this is probably a really good point to where a lot of people, a lot of traders, especially when they're beginning, are looking for that holy grail type system where they're going to get a signal service from a provider or they're just going to read a newsletter. But this is where some of the biggest deficiencies are, because what a lot of those systems do is they don't differentiate between a trending market and a sideways market. So, what could be working for months on end, and you might think, well, here we are, like we can, let's remortgage the house and put the money in, can go all sideways all of a sudden because the market's changed, but the signal service hasn't, primarily because it's being run by electronic advisor that isn't really adapted to the change in the market. So it's vital that you understand your own system and the ins and outs of it so you can actually apply it to the right market. Now, there are three different markets that you're going to find. There's a downtrending market, an uptrending market, or a sideways market. Now, the good thing about it is that there's many strategies that you can apply that work in every single one of those. It's just a matter of finding the right one and understanding which one is going to work in the particular market that you're seeing.
Yeah, absolutely right. Another one that we always talk about when developing a trading system is what specific circumstances trigger an entry signal. And this is one that way too many people fail at. I find that people will have a system and then you'll say, okay, well, how do you enter that system? And they'll say, oh, I just buy or sell it. But why and where exactly are they going to be buying, selling it? And what's the reason that they're going to have effectively each time that is a constant? So one thing we always say to people is when you're looking for a candle pattern or something to do with a pattern in general in the market with price action, wait until that time frame's candle closes, because that's the only time that it's locked in the market. You can't change, and no one can go and manipulate a candle that's already closed. If a daily candle closes, it's closed. It's locked in time. It's always going to be, that's when it closed on that day at that time. Whereas 5 minutes before that daily candle closes can look very different. And this is something that trapped us even as beginner traders. When we first started, that was something that definitely affected us, and it can affect all traders, especially on the smaller time frames where you're on 5 minute, 15 minute, because in the last 30 seconds, things can look very different. So be very sure of what your specific circumstances trigger an entry signal. And we'll be looking at a chart in a minute to talk about this. Anything else to add there, Ty?
Yeah, just probably, I just want to touch on the candlesticks and what they're trying to tell you. The reason why you're going to hear us harp on about daily candles in particular is that the daily candles give you the opportunity to have the buyers and the sellers interact with price for the three major markets. So you've got the Asian market, the European market, and the New York market. So a daily candle close really covers all of the buyers and the sellers from across the globe. Now, if you're only looking at a 4-hour candle, as much as it's more significant than a 1-hour candle, you're still not really capturing every single market. So you get a very, very good consensus of what's happening around the globe, really, when the three markets participants, the biggest market participants in the world, have their say in how that candle finishes. And that's why a break of a zone on a daily is far, far more important than any other time frame below it, purely because every major trading entity in the world has seen what has happened in the market and has had their say, whether it's a buy or a sell. And that price is affecting what the candle looks like when it closes.
Another one that we always see when you're developing a trading system is, do you know your stop loss and take profit levels when you enter? A lot of people don't. It's kind of easy to press buy or sell and get into the market with a market order, but very few people that I talk to anyway, at least when we initially engage them for coaching, they don't know where their stop loss and take profit are going to be, and they don't have realistic goals. They just say something like, it's going to be 100 pips away. Well, that's fine, but realistically, what's the market telling you? What's your trading system telling you? What are the statistics on where you should be always taking your profit and stop loss? And does it make sense to be something where you can treat it like a business plan, where you can replicate this over and over again? And that, of course, leads us on to the last point, which is create a business plan-like approach. So with any good trading system, you should have a points-based system. So if possible, if you have 4 or 5 or 6 or 7 or 10 or 15 different reasons to get into a trade, let's say you've got stochastic and MACD and pattern, like a channel pattern, then you have to assign those a certain point score. And when you get that point score together, let's say it's out of 100, maybe the most important thing in your trading system is the channel pattern itself. So you give that a score of maybe 70 points, and then you need at least 1 or 2 other reasons to be in that trade to get the 100 points. And that allows you to be more consistent in your trading. And I think it's something that really changed trading for us as well through all markets, having goals and always having a points-based system that we could just continuously follow.
So one of the number one rules, and for those of you that are taking notes throughout this webinar, if you want a real important point for any business plan, like Thomas alluded to, you should never, ever enter a trade until you've got an absolute hard and fast stop loss ready to go. It should be entered at the same time that you actually place a trade, generally in a pending order, or at the very least, instantly once the trade has been placed. A take profit, as much as they're important to know where your take profit's going to be, they are one of those things that can vary a little bit, because if you're trading, for instance, a moving average crossover system in a trending market, the take profit's not always as easily defined, because we can't really, pinpoint how long a trend can last. And obviously we want to be in the trade for as long as possible. But one thing we can definitely determine is where our stop loss is going to be at all times, because the stop loss is the only thing that gives us the ability to manage the risk of that trade. So it's not a case of just, throwing down, 100 pips and saying that'll do. It's one of the most important parts of placing the trade. So make note that that is very, very important and an integral part of any trade planning system. A stop loss must be determined before a trade is entered at all times, and under no circumstances will that ever change.
Yeah, that allows you to keep it more consistent, because you can say every time I want to risk $100, $200, whatever it may be, 1% of my account, 2% of my account. We'll talk about this in risk management, but it means that you can keep a more consistent track record, and you're not just going through wild swings of getting massive profits and massive losses, and that can actually hurt your psychology, and we'll again talk about that with your trading system. But very, very important rules to always have, hopefully a stop loss when you're placing a trade. So I want to just quickly jump into this euro US dollar and just talk about one of the points that we brought up, which was, of course, that you really want confirmation for your trades. And I think this right now, what's happening with the euro US dollar is a really good example of that. So what we can see here is I've drawn this support line just through the bottom of the euro US dollar at this price here. And what I wanted to mention was, if the euro US dollar was to break through this support line and go to a new low, we would really want to see a confirmation close before we got involved potentially with the short opportunity. The reason that is because we need to make sure that the market has closed, let's say on the daily in this case, and broken the low, and it's locked in time. It hasn't just wicked through, come down, and then at the end of the day, it's back up at this zone. So it must close underneath this point here. You can see on the left-hand side what can happen. The market goes through, it then buys up, and then it closes a higher point. So it's really important that we wait for that confirmation close where the market breaks to a new low. And why I bring up this example is I think it's just always interesting to see the euro US dollar on the support here. At the same time, we're seeing the US dollar index, which is in your Pepperstone platforms, and we're seeing that on the resistance point here. So if this resistance was to break, we would probably expect our euro US dollar at the same time to be breaking the support. And that might be due to news or whatever reason. But when that does happen, that'll be a technical signal for a lot of traders out there. And it's important to see these kind of things when it comes to your trading.
It's a really good idea to incorporate the dollar index when you are doing, in particular, Euro USD, especially longer time frame analysis, because it does give you a very, very good insight into what could potentially happen. It also gives you that extra confirmation. As you're probably aware, if you look at these two side by side, both of them are basically replicating each other exactly in reverse. So what one will do, the other will definitely follow, or almost certainly, especially on the euro, which makes up so much of a percentage of the dollar index. So it's a really, really good idea to keep this chart, the USD dollar index, somewhere locked in where you can just refer to it. You don't have to trade it alone, even though you can, but it's a really, really good reference point, especially when you're doing your analysis on the euro.
Yeah, really underrated tool. In fact, it wasn't always on a lot of brokers, so it's great that Pepperstone have this. Love the US dollar index, can't say enough about it. All right, let's get back into talking about just a business plan strategy. So this is just an example taken from one of our courses on fxevolution.com, but I think it comes up with how many different reasons you can have to get into a trade. So we call it the pressing system, and it's price action, risk management, thing called ELD, which we have chart patterns, indicators, and charting techniques. So we often, or whenever we're placing a trade, we will use all of these reasons, and we like to use at least one for each one of these letters before placing a trade. We'd like to have at least one of these reasons to be in the trade, and then we bring that together into a score, and then that creates a really powerful trading strategy. So it's a lot of these kind of ideas, even in your own trading system, just breaking it down to a point score can make the difference between being successful and not successful. I cannot stress it enough. Massive changing point for us.
It's a really, really important concept in trading. And a lot of people are probably going to think, well, maybe this is only for long-term trades where you've got time to spend half a day setting up a potential trade setup. But look, nothing could be further from the truth. Our pressing system, on average, you can generally get through it in about 1 minute to 2 minutes, and you've done all of the analysis that you need to do, because it's actually just there for you. You just basically go through and tick box all the things that are present and all the things that aren't. Now, you're not going to get that from the very first minute you do it. You've obviously got to learn the techniques, but when you do them, it becomes second nature. So even if you're trading a 5-minute or a 15-minute chart, doing analysis is a very, very quick process when you know what you're looking for. And that's another part of really understanding your strategy and knowing exactly what you're looking for to give you the opportunity to place the trade.
It's like cooking bacon and eggs. First time might be a bit slow. The second time, third time gets faster and faster until you've got
The ingredients are sitting there just by the oven. All you've got to do is use them.
And I
And
like
it is the
bacon
same.
eggs.
Look, I know we say that and we're a little bit, jokey about it, but it's actually really true. You understand the tools that you need for the strategy that you're putting in place. The trade's either there or it's not. It really is as simple as that. Trading can be turned into a very, very complex situation for a lot of people, but believe me, take it from people who do this for a living. Trading is not complex when you understand what you're looking for and you use the right tools to do it. So, don't lose heart. It's not rocket science.
Another tip, just quickly on the trading plan. I know someone actually did it from one of the webinars a little while ago. Some people actually print their trading plan, laminate it, and then just use a texter they can scrub off just to tick their points. So rather than using like an online system like we do, where it's just tick boxes, in that they've got a physical one in front of them. So there's no problem with that either. So a lot of different ways to get to the same goals.
As long as it works for you, it's going to work. You just need something that's going to work for you.
That's right. So another important thing with creating a trading system is establishing the right time frame for your trades. So some people are going to be day traders, some people are going to be swing traders, and some people are going to be scalpers. I know we have a lot of scalpers out there, but this is just what people are going to have. You're going to want a certain thing, but you need to be aware of what each trading system is going to take from you. Because if you're a scalper, you're going to need to be in front of the charts a lot more than if you're a day trader or somebody that uses a daily chart or something like that. If you're a swing trader, you may need to be in the front of the charts a decent amount of the time and check maybe one or two markets, but nowhere near as much as a scalper. So you have to really make that decision when you're coming up with your trading system. It's really important that you make that decision and you do dedicate to that and give it a fair go. You can't just say, I'm going to be a scalper, and then the next day you're a swing trader, the next day you're trading dailies. You really need to define what you are as a trader and become great at that part. So with these time frames, does it fit your personality? Do you want to be constantly engaged in the market, or more of a daily check, set, and forget trader? So I think we find some people, they may be retired or don't have a job, or they're trying to make a second income. They may like being a scalper, but we do find that predominantly a lot of the people that we teach, they love the idea of trading daily 4 hours and doing a bit more of the swing, because they can check the market once or twice a day, set and forget. And that's really, this is a beautiful thing about trading. There's a lot of ways, a different way of doing it.
There's no real right or wrong way. It really just comes down to what suits your personality and what suits your, I guess, ability to spend time in front of the charts. Now, look, where you live in the world is also a very important factor. I mean, if you reside, in the US or in London, you've got the best trading opportunities throughout the day. Whereas in the Asian markets where we live, a lot of the time, our busiest times are actually spent in the stock market, because during the day, the currency markets aren't moving all that well. But, once London opens and once the European markets start to kick in, scalping strategies come straight to the fore, because that's where the scalping strategies really are activated. There's so much volume and so much movement that you just don't see generally through the Asian session. And I find, especially when I first started out trading, I learned pretty quickly that the New York session was one of the best sessions to trade after London closed, because that was the only session that didn't have any conflicting views. So what you find when the London session and the New York sessions are open together for that 4 or 5 hour period, the market can be very, very volatile, because it's almost like two beasts taking on each other. Quite often the big central banks don't agree with what the other wants to happen or is trying to make happen. Whereas when London and the European markets do close, the markets seem to settle down in New York, and basically the ebb and flow of what happens after that is a very, very smooth technical process, which is really, really nice to trade. But unfortunately, that's about
Yeah.
3 o'clock in the morning for us.
Yeah,
So
you had black panda eyes when you used to trade that.
yeah, for those who haven't experienced that, and if you are starting out and you are looking for the best time to trade, I highly recommend those 2 or 3 hours after London does close and the New York market is the only one open for very steady and fluent market movement.
So try different time frames to get comfortable. And many traders start with low time frames and really won't try the 4-hour and daily out. I know we were definitely like this back in 2007 and 8. When we first started, everyone loves the 5-minute, 15-minute. We just thought 4 hours is too big and daily is too big. So it's more important when you first start, you need to look at the different time frames, come up with that. Do I want to be a day trader, swing trader, scalper? Try each method and then decide on one and become an expert at that. So that's just really important. And of course, that's why we have the last point, master one approach before you move on to new ones. So really important, even if you're picking up currencies, some people, what we'll find is they want too many pairs. So they'll go at the start, we always recommend US dollar majors, maybe gold, those kind of things. So just major pairs. And some people start with Mexican peso and Singapore dollar and those kind of trades, and they are more difficult. You know, they're not as technical because there's a lot more fundamentals going on in those currencies. So really, if you stick to kind of the blue chip, I guess, of currencies, often you'll have the most success. You can become expert at that, and then you can become maybe a side expert at something like the pound yen or the pound odd or whatever else you pick, because they're volatile and you enjoy those trades. But you've still got your bread and butter that you formed through the euro, through the pound US dollar, through the odd US dollar, those kind of pairs. So really, really important to master one approach and then often master some currencies, because everything does trade a little bit differently.
It is really good to understand the currencies that you're trading, because straight away you have a touch and feel for what the average moves for a day are. So let's say, for instance, you do focus a lot on the euro US dollar. You know that if it moves 200 or 300 pips in the space of a couple of hours, that is an unusual move that could be triggering either a big event, or has been triggered by a big event, or the market has finally turned around and broken a key support or resistance zone and is about to set a new standard of what's going to be the new normal. Whereas if it only moves 50 to 100 pips, which is very, very normal and very within the range of a daily move on the Euro USD, you understand that the market is actually behaving exactly as you would expect it. So you can trade that with that same confidence without being fearful that an event is taking place or a market movement is taking place that could really affect the strategy that you've got in place for a 50 to 100 pip move. Now, the other side of that is what we were touching on earlier, is, and we're going to touch a little bit more on it with the risk management, which is what we're talking about on the next slide, is that when you understand that the Euro USD has an average move of, say, 70 to 100 pips for a particular period, you know that you can be a lot more, I guess, conservative with your take profits, because you'd be foolhardy to be placing a take profit of maybe 200 or 300 pips when the average move for the Euro USD has only been 70 to 100 per day, and it's fluctuating up and down and not really going anywhere, especially if you're trading a sideways market. So it really gives you a good insight when you know the currency pair that you're trading well, to have a really, really good understanding of where the take profit and the stop loss, for that matter, should be.
One other point I just want to bring in that comes into risk management, some people leave their trades on over the weekend. And of course, that can incur gapping in the market, where the market will close at a certain price, something will happen over the weekend, then it'll open at a different price. And a lot of new traders don't realize that they could be either benefiting from that greatly or definitely not benefiting from that greatly. And it can be something pretty bad if you're trading large contracts on a smaller time frame. So by trading some of these more blue chippy kind of bigger currency pairs, you aren't going to generally experience the bigger gaps, whereas some of those side currencies, you can get some massive gaps over the weekend. So you need to be a bit mindful of those things as well, because unfortunately one of those mistakes could potentially cost you your account depending on what you're doing. So you need to be really, really aware that you've got to take risk management into account. And that's why we're going to talk about sound risk management strategies.
There are two ways to mitigate that risk. I will touch on this quickly, because a lot of people do hold trades over the weekend. There are two ways that you can do it, that you can protect yourself really well from it. If you've got a trade that you're still very, very comfortable with, but has to run over the weekend, you can close that trade off and reopen it again Monday morning if it's still in the zone that you're comfortable with. Or you can reverse that position to the exact contract size at the same point at around the time the market's closing. Yes, it's going to cost you, a pip in spread, but believe me when I say, if something happens over the weekend and it goes against you, that 1 or 2 pips that it might cost you in opening and reopening a trade will be nothing on the 200 or 300 pips that might have moved. Now, I know you might think that's a bit of an exaggeration, but believe me, it can move 200 or 300 pips, even some of the bigger currency pairs, over a weekend. And you've got to remember that the weekend, you're talking about a 48 to 56 hour period where you've got G20, G8 summits. Some of the biggest world summits in the world happen. Basically, the biggest countries have their summits over the weekends. So there's a lot of wars break out over weekends. All sorts of things can happen over a weekend. So there's just an absolute multitude of things that can happen. So it is always better to protect yourself. It might look like you're costing yourself money by spending that spread, but think of it as insurance.
And that's particularly important on the smaller time frames. If you're trading daily, weekly, obviously, man, 100, 150 pip stop, maybe not as important, but if you've got a 30 pip stop, potentially quite important. So be smart with your risk reward strategies. 1 to 2% of capital. You've probably heard this one before. Everyone talks about it. We talk about it because it's really true. Risking 1 to 2% of your capital is actually quite a lot. Some people risk 0.5%, 0.25%. It really depends what you feel comfortable with. But when you start risking more than this of your capital, you really aren't giving yourself a fair shot to be successful in currency trading. If you're risking 5 or 10% per trade, if you lost, let's say it's 10%, if you lost 10 trades in a row, how much have you got left in your account? Nothing. So the problem with risking too much capital is you're not giving yourself the statistics that you need. Even if you had a 75% winning strategy and it was a 1-to-1 risk reward, you can still potentially go on a big loss streak during a market that isn't behaving the way that it should be for whatever reason that you haven't recognized. And you really just need to give yourself 1 to 2% risk if possible. So that's definitely one that we'll always talk about, and it's very important.
And a lot of people say, well, if you're only risking that much, how are you actually ever going to make a living? But when you think about it, if you're looking at 2 or 3 to 1 trades, which is usually what you should be looking for any good trade, would have a 2 or 3 to 1 risk reward ratio. And by that we mean, if you've got a 20 or 30 pip stop loss, your take profit is going to be 2 to 3 times bigger than that. Okay, so if it's 3 times bigger, it's a 3 to 1 trade. Now, say for instance, you only trade once a month, and you happen to get 2 3 to 1 trades and lose 2 trades, you're still going to be up around 4% for that month. Now, if you can replicate that, for a year, you're up 50%. You've outperformed some of the best fund managers, in the world, with all of the, fundamentals and all of the tools that they need at their disposal. You've outperformed them to the tune of about 40%. And that's only placing 5 or 6 trades a month, let alone people who are going to scalp, who could trade, maybe 10 or 15 times a day. So as much as it doesn't sound like, 1% of your account is going to, make you the money that you need to do, I think you might be quite surprised how quickly that can build up when you're looking at 2 or 3 to 1 risk reward ratios.
Yeah, so just with that 2 to 1 again, if you were, let's say, risking $100, a 2 to 1 risk reward would mean that you're making $200 for that $100 risk. So it's just really important that you understand these risk rewards as well, because if you have a 0.5 to 1 where you're risking $100 but you only make $50, well, guess what? You need a very high percentage win trading system. And I do find, like anybody out there, most people cut their winners short and take heavier losses. So you need to be aware that even in a 2 to 1 risk reward system, there may be something where you'll expect 2 and you'll instead take a 1.6 to 1 instead because of whatever reason. Maybe it's going over the weekend, you choose to close it or whatever. So you need that little bit extra percentage in your favor, but you also need to realize that by changing your risk rewards, which is going to happen, you could affect your statistics, and it sometimes just does happen. So you've got to stick as much as you can to those rules and those point-based systems, just like a business. You'd always stick to the business plan as much as possible. And this comes down to know when to get in and out of situations and have a plan for all situations. So have a plan for what happens in this scenario. What happens if the market comes back? How is that going to affect my psychology? So a classic case is a breakout of something like this euro that we saw over here. So breakout of the euro, let's say the euro did break to a new low and the market came down like this and it broke to a new low. What's going to happen to your psychology if it comes back to this point here and does what would often happen, which is just standard role reversal? Is that going to affect you? Do you have a plan around that? It's very important.
Anybody who's done all of our webinars or have done any of our courses would know that if that actually happened on the euro, you'd almost be celebrating. But for people who don't know those rules, a lot of people would be very worried that potentially their stop loss is going to be hit or the euro is going to reverse. And that's where the psychology and risk management go hand in hand, because if you're risking the right amount of capital per trade, you're never really going to be concerned if a trade is going to fail on you, because at the end of the day, you're risking the right amount. If you've got a $100,000 account, you're only risking $1,000 on that trade to potentially make $3,000 or $4,000, which is very, very sound. But if you are only having a $10,000 account and you're risking 10% of that trade, that $1,000 is all of a sudden a very big deal, because if your $10,000 account drops to $9,000 because of one trade, you've so heavily leveraged yourself that you're going to panic. But more importantly, it's really going to give you the psychology booster to actually take that trade out early, where that trade should be making you $4,000 because it's a 4-to-1 trade. You're going to make $2,000 on that trade and probably cut it early, because your $10,000 has turned into $12,000 all of a sudden. And you're going to say, well, that's great, I've made 20%, how good am I? But in reality, it should have made $14,000. So you're going to cut your losses, you're going to cut your wins short all the time because you're over leveraged, and you're going to let your losses run every single time. That I can assure you. No one ever takes their losses early.
Always happen. That's why it's important you've got your stop loss in before when you place the trade, exactly, because otherwise you'll move the stop loss down and those kind of things. And we won't talk about it anymore, but that's definitely one. One last point I just wanted to touch on was identify stressors. I actually don't hear enough people talk about this, but let's say you've got your working still and you're trading on the side. If you've got important meetings, deadlines, family stuff, things are just going hectic and crazy in your life, maybe it's better you don't trade at that period in time. And the reason why that is you're often going to make a mistake. And we can all attest to this. Or even worse is you'll get into the trade and then you'll suddenly be looking at it because maybe you've over-risked or something else will happen, and it will affect your important meeting or your deadline or other things. And I find a lot of people do that. So always be aware, identify those stresses if possible, maybe don't trade on those days.
It does kind of roll into our quote of the week. For people who follow us on Instagram or on Facebook, we put out a quote of the week, and a lot of the time we usually use expert quotes from historical traders. And this week I decided to do one because it actually touches on that. Because choosing not to trade because a market condition is not correct, or because you have those stresses in your life, is actually a trading strategy in itself. Choosing not to trade because you're not in the right mindset, or the market is just not agreeing with what you're trying to achieve, is a trading strategy, because it's one trade that you're probably not going to have to make up to actually get in front again. So don't ever think for a minute that if you spend time analyzing the charts and there's no trades there, that choosing not to trade is a bad thing, because if the market's not right, it's just not right, and you're better off walking away and saving it for the right market conditions. We're blessed with, thousands of different opportunities to trade each week. You never have to force yourself to trade a particular situation because you feel you need to.
Yep, and that's why you need to stay in control of your emotions, and obviously then there's market psychology. So most people lose in trading due to not staying in control of their emotions and not understanding market psychology. And they usually let the market or their emotions get the better of them. A great example of this would be FOMO, which a lot of people probably know of nowadays, and that's the fear of missing out. And this is really a thing in the markets. I mean, I think the most classic case I can think of recently was cryptocurrencies. There was people were talking about FOMO, they were even admitting to it, and they just continuously were buying it up and up and up because they were fearing of missing out, thinking that Bitcoin was going to go in that period of time to $300,000 or $1 million. I even heard all sorts of things.
I read a stat the other day that actually more people bought Bitcoin above 17,000 than they did above 5,000, which goes to show you how many people were actually really trying to get in when the horse had potentially already bolted. But the FOMO effect.
I had an 82-year-old calling me. An 82-year-old called me to say, I want to buy Bitcoin. I said, I don't think you understand what it is. But the thing is that's what was happening. It was really deep penetration through all age brackets. Everyone knew what it was. FOMO was in full effect. And this happens in currencies as well. It happens in commodities, happens in oil, happens in gold, specifically gold. That's one that sometimes that really does affect. So you need to be important to understand this market psychology, because sometimes it can go maybe unrealistically long, but you need to be aware that it will potentially correct, and when it corrects, it will be massive. So you can trade those opportunities as well. So another one, we talk about writing down and keeping track of things. Writing down your feelings during trades. Now, obviously, you can't do this every single time. It'd be great if you could. But when you make a trade or you make a massive mistake that you go, I cannot believe I did that, it's really important for you to document that however you can, so that if you ever feel that happening to you again, you can look at that document. If it's physical in front of you, I don't care where it is, but it's something that you have where you can say, oh, how did I feel last time about that? And you can say, you can bring yourself back more to the norm, I guess, or more to your calm state when you're placing that trade, because that mistake, and we have great examples of this throughout time that we've traded with people and know people. Sometimes there's a trader and they're there and they're having great success, and then they'll go quiet after one night, and then you'll never hear from them again. Or literally they'll contact you 2 months later and say, I had a really bad time, and like I had a really bad period in my life or something like that. And you always know that's because they made a really bad mistake, usually at 3 a.m. in the morning, where they just went crazy. And that's the kind of thing you never want to forget.
It's the exact reason why this whole webinar and the focus on having a trade plan is so important, because this is what protects you from making all of these errors. When you've got a trade plan in place and you're ticking the boxes, and the trade is either there or it's not for the right reasons, or it's not, it really does stop a lot of these things that we're talking about now. It really fixes all of the risk management. It helps you stay in control of your emotions and market psychology. And probably one of the most important things, and the last point that we've got here, it prevents you from revenge trading, which is the biggest account killer there is. Don't worry about GFCs, and don't worry about Brexits. The biggest account killer of them all is the revenge trade. We've all done it, and we may all do it again. But that is the one thing that you have to take out of your trading psychology. And the one thing that a trade plan does force you to do is it does remove the ability to actually do revenge trading, which never really works out.
And of course, then there's biases formed on trading instruments. So sometimes there is too much information, and they do say sometimes knowing too much is a bad thing. And this comes down to when you're reading newspaper articles, when you're reading Bloomberg, when you're reading any other article, sometimes you can get a bias formed on that particular currency due to reading these articles. What you're better off doing in currency, or at least we've found, is trading what the currency is telling you. A classic case, everyone's been all bearish on the Australian dollar for years now. And if you look at what happened actually, not just recently, but at least for the last year and a half before that, it really only went up. So you're looking at a market that's going up, yet if you went and told 80% of the population out there what's going on with the Aus dollar, they'd say, oh, I think it's going down. So it's that bias that was formed due to so many articles being written about in 12 months time, we're going to see it here in 12. You don't care about that. What's happening in 12 months is not going to help your scalping strategy on the 5-minute chart. So make sure those biases don't come into play, and you trade what you see and what the market's telling you. really,
We want to know what's
really
happening in the
important.
next half an hour when we're scalping on a 5-minute chart, not what's happening
Yeah.
in December of 2019.
That's the worst. As currency traders, you guys are going to get the question from some friend. I'm going to Hawaii. I need to exchange $500. Do you think it's a good time in 6 months' time? And you're going to say, I have no idea. Because you really shouldn't really know exactly what's going to happen in 6 months. You're focused on currency generally in the days, weeks, maybe months. But yeah, that's a classic one we always get. It's very funny. So last one, journal and track everything. So of course we want to trade, well, trading is a constant learning experience. Even we're learning all the time. That's why we're so passionate about it, because it's so interesting. And you must always learn from your mistakes. Really, really important for everybody to try to learn from when they make mistakes. One of the things we did was we would, and it's the last point here, spend time going over our strategy each month. We would actually sit down, we would put it on a projector, with a couple of beers, and we just sit there and literally go through each one of our trades. What did we do well? What didn't we do well? Where were the mistakes made? And try to learn from those experiences. So very, very important. Another one is to track each trade with the snapshot. So before we can go over the strategy at the end of the month, we obviously need some form of snapshot software. Look, we use Snagit. It's not free, but it's a software out there. You can use heaps of different ones. You can even use the free Windows one or Mac ones. So that just take snapshots and then you draw on them. So
the snipping tool on Windows 10 works actually quite well as well, and
yes,
that's
Windows
free as part
10
of Windows 10.
good, and that is free. Yeah, so a lot of students use that. We're just using something that we used from 2007. So that's the way we do it. Yeah. And
the
then,
review process is very important. The review process is very, very important. So it is really important that you actually snapshot your before and afters, because every professional organization in the world does reviews, and trading is no different.
And yep, every business does reviews. You always review your numbers, you review where we're going to do better. Those are the things that make a business move forward. If you stagnate or stick to your current system, the problem is usually those businesses fail. You know, there's a lot of businesses out there that you'd remember as a child and you go, okay, that business is pretty popular, and then it's not around today. And that's partly because they actually aren't constantly trying to learn from their mistakes and trying to adapt to the current markets. And things just change. You're always learning, always learning. So what you need to do with trading is focus on your strengths and try to eliminate those weaknesses. So whatever your weaknesses will be, some will be psychology based and emotion based, some will be just even parts of your trading system that may be a weakness. But when you start to focus, or when you start to see some things working, focus on them, become an expert at them. And I think that's just what we talked about before. And then hopefully you guys can be successful traders. So it's all a learning experience, and this is a life lesson. This is something you can use forever, which is excellent. It's really great thing about trading. So we're at the end here, so hopefully just put in your last questions if you've got any. I just wanted to quickly mention for people that are in Melbourne, we will be doing a free workshop. I think it's in September, and this is a live workshop in South Bank in Melbourne. So feel free to go to fxevolution.com/fxevolution workshop. That's something that you can definitely do if you're interested. And we'll be talking about a lot of these things, but really going into in-depth trading and how we trade, and some things that you guys can really implement into your system. So that's interesting if you're in Melbourne. So we'd just like to say thank you to everybody for attending, and I guess if we've got any questions, we'll go over to them now.
Yes, so we have had a few questions. The first one was actually in regards to placing a stop loss in short time. I know that we spoke about obviously within like 5-10 minutes when to place it and stuff like that, but he was wondering, when you place a trade, as it's happening all quickly and the things can change so quickly, when would be the best time to kind of analyze your trade and get in and get out? Because sometimes people enter the trade and, like you said, they don't know where their stop loss is, or they don't know where their take profit is.
Well, that's a weakness in their trading system straight away.
Yes, that's an error that is a weakness straight away. So even if you are trading on a 5-minute chart, even on a 1-minute chart for that matter, you've gonna, at the very, very least, you've got to put your stop loss below the last swing low, or below the low if you're going to go long, or above the most recent high if you're going to go short. So even if you're scalping on a 1 minute chart, that rule would never change. So at the very, very least, your stop loss has to be above the highest high or the lowest recent low, depending on what direction you're going. And that goes for any time frame. But in particular, if you are trading the fastest of them all, which is the minute, at the very least, that's where your stop loss needs to be. Now, for scalping, I do understand the question in that if you are scalping and you're only going for a handful of pips, by the time you do your analysis, the trade could be gone. I'm assuming that's probably the path that they're going down. At the very, very least, give your stop loss a bit more room to move. And then if the market goes in your direction, then you can creep it up. So you can either use a trailing stop loss to help it trail your trade, or the minute you've got a handful of pips in your favor, but you still want a little bit more, move your stop loss to break even at that point. So, but being a scalper and only going for a handful of pips is no excuse not to use a stop loss. In fact, that's actually the most dangerous method of them all, because that's when the market can really turn against you. So at the very, very least, in the most simple form, if you're going to go long, put your stop loss behind the most recent low. And if you're going to go short, place it above the most recent high.
And realistically, just when you are placing a new order or something like this, and you've got your order open window, like here, you can also use the mini terminal if you're using MetaTrader 4. So you can ask your Pepperstone representative about this, but that's a very quick tool as well to be able to get into the trade quickly.
The smart tools is very, very
yeah, you can have a fixed stop in there. So you could just say, okay, every time I place this system, maybe I have a 10 pip stop or a 15 pip stop just in case something goes crazy, and then you instantly modify that to the more price action based trade. So that'll allow you to get in, you've got some kind of risk protection, and then you can modify it after.
And the smart tools allows you to save a template. It does actually allow you to save a template, so you can have different templates for different market situations. So it's very, very fast.
Yep.
Cool, good stuff. Yeah, and we're also, I know we briefly touched on trading or talking about news. Well, for a new trader, would you recommend trading news at all? Because people obviously get drawn into it because it is so exciting. Yeah. But what would you recommend for the new guys who want to trade news? Back away or do your research? What do you think?
Look, you've pretty much got to back away from it. It's the thing with trading news is it's really, really difficult to be able to predict what that news is going to do, specifically even non-farms. Even the market doesn't know how non-farms is going to work out. It'll go, that's why often non-farms will push 100 points or 100 pips in one direction, and then by the end of the night, it's all the way back to where it started, because it's a strange figure that they can't actually really analyze quickly. It takes a bit of time for them to figure out what are the ramifications of this number. So I would suggest stick to your technical systems and try to trade outside of the news if possible. That will give you more of the business plan, and then you will know your statistics as well, because you're trading technically, you're trading in a controlled environment. News is not really controlled. It can get wild. But on the flip side of that, just remember the really important news in the market is generally going to be interest rates, non-farm payrolls, maybe GDP, even CPI and those other releases. They might push the market 30, 40 pips, but they generally don't have a huge 100 or 300 pip kind of move that the other ones can have. So I would say steer clear of news if possible.
Good stuff. And we do actually have a couple questions on when you create a demo, how long would you recommend trading on it until you believe that your strategy is working well? Is it a personal kind of preference, or is it something that, say, 10 trades or?
That's actually one. Really, it's a good question. I'm going to take this one because I do a lot of our beginning traders who are actually asking this exact question. What we actually encourage is actually skipping the demo process and actually moving to a live account, but only trading micros. And what that does is it means that you're only trading a matter of cents. Okay, so you can. The good thing about Pepperstone is it allows you to put as little as a couple of $100 in your account, and you can trade as little as 1 cent per pip move, which is really nothing. So what you're effectively doing is risking probably less than a cup of coffee on your trading strategies. And although that might sound a little bit silly. What it does make you do is be very, very accountable for the trades that you're placing. What I found is what a lot of people do in demo accounts is they become a little bit reckless and just a little bit lazy in they're not really replicating what they will do in a real live market. Where even if you're in a live account and you're actually trading real money, even if you're only risking say 50 cents to 90 cents a trade, it still makes you accountable and you actually are going to follow through a lot more. And then as your account grows, your confidence grows with it. So to that end, and the reason I know this works well is because I've got an 18-year-old son who did our trading course basically when he was 14, and he started trading with only 50-cent maximum risk, and he grew his $50 account to a $60 account in nearly 3 months, and he was so excited by that. But a lot of people don't even realize what an achievement that is when you're actually only risking 20 to 50 cents per trade. So what it will do by trading real money, even though it's only very, very small amounts, it gives you the confidence that actually your strategies will work in the real market. And then you can build your account from there without having to make that big step from what is effectively monopoly money to what a real account situation is.
Yeah, don't be the one that has the $1 million account and trades 100 lots per trade, because that's just not realistic.
We see it all the time. People come back and they say, "Oh, look, we've made 30% in our demo account." Oh, but wait, we didn't have any stop losses, and the account did go to 90% drawdown at one point. Would that happen in real life? Well, of course not. And that's why real money, even if it's only a small amount, is far better because it makes you more accountable, and you can see the real results coming through, and it gives you a lot more faith in your strategy.
Great. We've got probably time for one more if there is one.
Yeah. So we actually looked at a break of, so for example, when we looked at Eurodollar, a break in a daily candle. When you're trading, say with a 15-minute or an hour candle, are you still looking for the candle to close, or would you kind of take the break and pull back and go, or do you want that candle to close?
Yeah, great question. We need the candle to close no matter what time frame. These systems, it doesn't matter what time frame, you're always looking at the close because that's when it's locked in time. Now, if the close happens and it goes too far for your risk reward, what you can do is you can wait for it to pull back into that zone. So like what we were talking about with the potential breakdown, and then it comes back and it pulls back into what I guess we call a conservative entry or a role reversal area. It can be your entry if the market's gone too far on the closed candle. So you just got to be patient. Trading's about risk reward statistics, making sure that you're constantly giving yourself the best opportunity. So it's a great question, but always wait for the close, because that's the only time that it's locked in that's exactly what's going to happen in the market.
Perfect. I just have one more, which I thought was quite important. It's in regards to news again, and it's people putting pending orders before the announcement come out, and whether that's a good idea. I wanted to bring this up because it's quite important, because people do this, and I think it's not a good idea.
Oh, you mean they straddle the news, so they have a pending? Yeah.
So before the news, they've got a pending order to, let's say, go long. News happens, it gets taken up, and then
and they'll get both sides hit up potentially. So it's not ideal. If you go to the thing with news is the market can move incredibly quickly. Often it can move so fast there's even no liquidity, especially non-farms. It can move 100 pips in a second. So when you're doing that, you are taking a risk, and you've got to ask yourself the question: would I set up a pending order with $1 million account, even if I was risking 1 or 2%? So that's $10,000 or $20,000. If you would not do that with any of your trading systems, you would never risk $10,000 or $20,000 on that trading system. You shouldn't be doing it, and that's just the way it is. If you can't replicate up to that, or you can't replicate your trading system where you went from maybe $100 per trade that you didn't care about, and then you went to $10,000 and you suddenly care about it and you can't trade the same, then something's wrong with your system. You've got to look at that. So pending orders come into news. I don't recommend it, because you can, especially if you've got something like a pending order with like a 10 or 15 pip stop, what can happen is the news comes out, your order gets executed and closed straight away because the spread has widened because the movement was 100 pips, and that just happens. And then all of a sudden you're not very happy, and you're probably calling your broker and not very happy.
It can get you on both ends. You could have a straddle. It could easily get you on both ends. You could lose on both trades. And the truth of the matter is, you're really speculating on the actual announcement. And if you're going to do that, it's just as easy going and playing roulette, really. Because you are guessing black or red. So there are so many good trading opportunities that are built on sound plans. Best to stick to those because professional traders don't trade the news. That we can tell you.
The news just helps their trades. So remember, if you're in a longer term trade, often the news is helping you in your direction. I don't know the exact statistics behind it, but it would be over 50% of the time, that's for sure, that news is actually benefiting you and pushing it in the direction of the trend. That's why they say the trend is your friend. So hopefully that's all the questions. Thank you very much for coming out tonight. If you do have other questions we didn't answer, we apologize, but we do only have a certain amount of time. And we look forward to seeing you in the next, I think, 2 weeks, something around there. But the markets are pretty interesting at the moment, so there's lots of opportunities, and we hope you have a lot of success.
Yeah, and for those who don't reside in Melbourne and would like to attend our workshop but can't live, just pop in onto our website and leave your details because we are going to do a web-based version of it after the live event as well. So for people who aren't in Melbourne who can't make the live event and would be interested in going, just leave your details and we're going to do a live one and we'll be able to send you information on that. But look, thanks again for joining us. Sorry we've gone a little bit over time, but it's been a very important topic and I hope you've taken a lot from it. And thanks again for your questions.
Excellent. Thanks, guys.